Now, if we look back over the past 10 years, what have we had? Why have we had one of the biggest bull markets in a generation? We had an economy which is known as Goldilocks. It's not too hot, not too cold. But we had strong earnings, but jobs are kind of weak. Average of slow GDP growth. When you look from 2010, 2019, GDP was only above 3% twice, and now is barely above 3%, 3.08% in 2015 and 3% exactly in 2018. But kind of slow. It wasn't like, 4, 5, 6%. Holy cow, it's heating up. The market's heating up. Inflation could, no. It was just like hot and cold. Not too hot, not too cold. We had tariff issues with China, potential government shutdowns, which happen every freaking month because our politicians are assholes. We all know that. Earnings were pretty solid. But then you had interest rates, especially 10-year, remained relatively low historically and kept pushing lower. Along with inflation, which the CPI was at 2% since 2012. Mostly, outside of a few years when it rose slightly above 2%, but it always fell back below 2%. And this is dating up to pre-COVID levels. Even when we look at 2018, earnings started to peak, but then what happened? We lowered corporate taxes. The earnings started to surge. That was more in 2017 going into 2018. Then in late 2019, what do we see? Earnings kind of peaking. GDP was slowing from 3% in Q2 and Q3 to 1.9% in Q4. This is the quarter right before COVID. And that's okay. Because the Fed was there to make sure conditions were super easy. Not too hot, not too cold. But that's what Goldilocks is. The Fed's looking at this going, no worries. Even though we see slow growth here and there, and they'll pick out certain things, even though asset prices continue to hit all-time highs almost every year since 2011-12. But just a little piece of economic data, GDP. It's a pretty big deal. Jobs weren't as strong. Just little things you could point to. And plus, listen, inflation was low, so let's keep interest rates low. There's no reason to go crazy. The Fed was there to help us out. No worries. Even on every pullback, it's a buying opportunity because the Fed's there to catch you. Goldilocks is no longer the case. And we're heading into next year, it's going to be different. And I'm always careful to say it's always going to be different, but it is going to be different because inflation is surging. The Fed's going to have to raise rates to control it. It's going to have to taper at a faster rate than previously announced. And you're going to have bulls out there. They're going to say, well, stocks usually go up during the early stages of tightening. That's bullshit. Because we have to stop comparing the past to the present and how it's going to dictate the future because we're in unprecedented times. I mean, 0% interest rates, trillions and trillions being thrown at every single problem. I mean, you throw out every investment book you ever read. If you read investment books over the past 5-6 years, you're losing money in the market. Buy low PE stocks, you're getting crushed. You're getting crushed. Because none of this makes sense, and nobody could look at which books are, hey, this is my experience, this is what I learned, and here's how you're going to make money by everything I did and the mistakes I made. However, this is a market that never happened in history. I mean, it's true for those people to say, hey, you know what? Stocks usually go up during the early stages of tightening. I mean, that's a fact. Yeah, but the S&P did not go up 3 straight years before those periods to the tune of 31% in 2018, 18% in 2020, and 22% in 2021. We didn't have those conditions where we were up that much. So all of a sudden, you're going to take 1 year that compares. Hey, the last time we could have been down 3-4 years before that. And regardless of what the Fed did, whatever. Yes, the market was probably heating up a little bit, and that's why the Fed was raising rates or whatever. Again, raising brief in 2018. You probably don't even remember the last time before that. I think it was 2008. Or 2007-8, leading into credit crisis, they were raising rates while the market was crashing, which is insane. Just shows you the Fed's so behind the curve. But the comparisons are all bullshit now. But when the Fed raises rates, you need to understand it because what they're doing is they're taking leverage out of the market. And we're in the most leveraged market in history by a mile. By a mile, not even close. That's why you're seeing a lot of risky names get nailed. Or names that are seeing that strong top-line growth, but they don't have it in their discounted cash flow going out to 6, 7, 8 years, the analysts. These guys aren't going to generate money for a long time. Those names are getting nailed. I mean, one of ideas, some of these names, I'm not going to just cherry pick like whatever. I actually screened for these names. Okay, these aren't bullshit companies. These are brand names with more than $10 billion market caps that have gotten crushed down more than 40% in the past 3 months. DocuSign down 60%. Their market cap is $26 billion. They shed over $30 billion in the market. Most of that we know was just a week ago when they reported the worst quarter you could probably ever see at a growth company. Peloton down 55%. That was a $30 billion company. It's $14 billion, right? So that was wiped out. DraftKings down 50% plus. Still has an $11 billion market cap. Remember, you're down 50% plus. You lost $11 billion plus in market cap just over the past 3 months. And Robinhood down 50%. Still has an $18 billion market cap. You go Bumble, LivePerson, SK Telecom, Lemonade, Compass, CRISPR, Beyond Meat, Virgin Galactic, Zillow, Snap. Snap's market cap is $75 billion. It's down 45%. Half of that wiped out. 30 days. Pinterest. $23 billion market cap. Zoom, $54 billion market cap. Those are the market caps today that are down 40% plus. 40% plus. Just over the past 3 months. No surprise, these names are getting destroyed. They're getting hit hard. The anticipation of leverage coming out of the market. They may think, well, you know what? We got China. China's the wild card, right? They're going to come to the rescue. It's a growth engine of the world, kind of 40% of the world's growth. Not anymore. China has its own problems. Forget about climate change. Just doing that for Beijing. And after that, they're ramping up coal like crazy, producing cheap energy, making a fortune, monopolies on rare earth minerals, killing us, right? Because we're idiots about climate change, deciding to change and have our oil companies, we could be energy independent. We are energy independent. Stop drilling oil. What are you going to replace it? We don't have anything to replace it with right now, but we're going to have alternatives in the future, right? You wonder why you're paying a shitload of money for natural gas, gasoline prices, heat your house, air conditioner, energy. You wonder why. That's why. Maybe you should have those alternatives in place before you have these oil companies and you force them to stop drilling because they're publicly traded and you have the biggest companies in the world. You could do your research on it. They have trillions in capital, have the biggest positions, are supporting this agenda right now. But getting back to China. Who doesn't care about climate change? They do right now because Beijing Olympics are what? A month and a half away? Kind of 40% of the world's growth. But China, look what happened after Evergrande. That was a very, 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 very big story. That kind of got swept under the carpet. Now, I'm not too sure if you saw the latest stats. I get them. That's my job. If you look at real estate, contract sales are down 38% year over year. Much, much sharper than the 30% decline that was expected. The government is trying to make borrowing easier. Not working. Those debt-laden developers are still in big, very, very big trouble. So they have higher borrowing costs, and they just shut those developers out of offshore debt markets over the past few weeks. What does that mean in layman's terms? Default risks are increasing for all these real estate firms, which most real estate firms carry lots of debt on the balance sheet. So what do we have now? We have inflation. The whole world knows it. Fed tightening, constant uncertainty about future COVID variants. I mean, you can't be surprised. Most firms are lowering GDP estimates. This includes Goldman Sachs, who lowered their Q4 GDP from 4.2% to 3.8%, and also lowered their 2022 full-year GDP to under 3% now. Am I right? Talking about 3%? Under 3% now. Now you're wondering why so many of these names are getting hit. You're going to see leverage come out of the market, and you have to be careful with the Fed, because the Fed, what have they done year after year after year? If you're looking at the credit crisis, the worst thing that happened to the Fed is they made a fortune. They made a fortune. Everything they bailed out. If you're looking at the banks, you're looking at the warrants, you're looking at Fannie and Freddie, who's still under conservatorship, which is illegal, by the way. They're making billions every quarter. They took all the distressed assets that are worth probably 2x to 7x right now, and they made an absolute fortune. So what do? During COVID? Just spend even more money. We're probably going to make even more money. But this time it was different. They didn't do it to shore up the banks and make sure people know their money is there, which a lot of those banks didn't even lend some of that money out, or most of that money out. Instead, they handed checks directly to people, trillions and trillions and trillions of dollars. $10.5 trillion in total for the U.S. $10.5 trillion. Put that in perspective, to save the world and the financial system, it was $480 billion. That's what they did in 2009, 2010. Now it's $10.5 trillion, and we're still going, right? Infrastructure, another 1.2 trillion. Let's keep going, keep going, keep going. So you have this massive leverage, but when you have troubling times, and even the Evergrande situation, or even the credit crisis or COVID, or things go under, you could always throw money at it to cure it, and that's fine because we have an unlimited printing press that's on every second of every day. However, with inflation, it's the opposite. The Fed cannot do nothing. The only thing that they could do, I shouldn't say they can't do nothing. The only thing they could do is provide tightening conditions. Remove leverage from the market. It's a lot different. So you can't rely on the Fed in that Goldilocks economy. The Fed's going to be there. So it's not going to be always a buy the dip on every single stock. It's not. I'm not telling you 2022, every company's going to see massive correction, even though we saw most of them have a correction already. I don't know if you're looking at the underlying conditions of the market. And yes, if you're looking at the major indices, they're still 4%, 3% off their all-time highs because Microsoft and Apple, if you look at Microsoft, Apple, Tesla, Facebook, Google, Netflix, Amazon, those stocks alone account for $12 trillion in market cap. $5 trillion alone just from Microsoft and Apple. $12 trillion of the $38 trillion in total market cap. And a lot of those stocks are at all-time highs, or pretty close to them. That's where the money's going. That's the safe haven. So that's keeping the major indices up. I mean, it counts for a third of it. But if you look at the underlying stocks, look at all those stocks that I mentioned. You look at ESG names, marijuana names, holy cow. And some of these things are down tremendously over the past 3 months. You're looking at it going, what happened? I don't understand. The market seems like it's doing good. It's really not. You're looking at the new lows to new highs. The new low list has been massive over the past 2 months. But yet you're seeing, hey, we're closing in all-time highs because a lot of it is top-weighted from those big technology stocks.